All right, great. Well, welcome back, everybody, for another meeting this month. Last month we had really good participation. I think we had 27 at last month's meeting, so we had a really good turnout. But it varies from time to time, depending on schedules and what's going on. And oh, thanks for letting me know, Trinity. Good. I'm glad you could both hear me and see the agenda. Awesome. So I know it's been final exams, so I know a lot of members are probably busy trying to get through that, which I totally understand since I have to grade a lot of those. So I'll be busy grading my several classes projects. So I welcome everybody to the meeting, and as long as I have your email address, especially if you've been here before, I always email all the handouts as well after the meeting so that you'll have it. Especially if you can't make a meeting, at least you can get the handouts as long as I have your email address. So one of the first things I like to ask, and I always pull out my little notebook of suggestions, are there any topics, and feel free to speak or type them in the chat box as well, that we want to talk about for next time. So both of our topics today are suggestions from the last couple of meetings, which I thought were great. But any ideas either for here or?
I'm brand new here. So
okay, that's okay. You're here to absorb all the knowledge,
yes.
Which is great. I'm glad.
I'm just kind of interested to see what this whole thing is about.
Sure. Yeah. And the reason why we have two meetings is we try to accommodate different parts of town and also different schedules, because not everybody can come to the day meeting or the evening meeting, and not everyone is near campus. That's why I like to have them at both sides of the river, just to make it more convenient as well. So I'll be asking the nighttime group if they have suggestions as well. But as we speak, if any idea that you've been wondering about, to learn about, and anything investing comes to mind, just let me know. Hey, Tyrone, glad you made it. We just started, and we are just asking if anyone has any ideas for topics for next month, since we are fully member driven for all the topics we talk about. But if anything comes to mind, I'll just write it down. So one of the most popular topics for years, and we always bring it up periodically because especially since a lot of our newer members asked for it last month and the month before, is what do you look for when you're shopping around for a stock? And so there's a lot of different things to look for that I can suggest that at least makes you a little more comfortable about being fundamentally invested into your particular stock pick. So let me pull up this handout right here, and I'm going to minimize that one so I can see the chat box. The very first one I put at the top is liquidity, and I learned from one of the best traders I know, who owns Tasty Trade, which one of my favorite brokers I like to use. For both stocks and options, and since I trade options, it's definitely one of the metrics that I use every day. So when I'm looking for something to trade, liquidity, one of the most important metrics for me. It's like, and from the best traders I know, this isn't my idea. From the best traders I know, it's their number one metric they look for. Is it liquid? Meaning that are there enough shares being bought and sold every single day? You want something liquid, and the reason why you want something liquid is because you want to be able to get as fair a price when you're buying or selling a stock as possible. So you also want to be able to buy and sell shares quickly. I sold several Apple shares today, and because Apple is such a liquid stock, I was able to get a good price, and I was able to get my trade executed in a matter of milliseconds. So how can we tell if a stock is liquid? So let me show you an example here. Yahoo Finance is a very user-friendly resource.
Is there any other like free tools?
Oh, I only show you the free stuff. So everything I show you is all free. CNBC is free, Yahoo Finance is free. Yeah, you could pay for tools, but if you have a brokerage, all of their tools are free too. So they give you technical analysis tools for free these days at most brokerages.
Like have Fidelity.
Well, Fidelity definitely should have free
They
tools.
should have like
Yeah,
free tools.
they should have free tools, definitely. So if you have a brokerage, and that's a great question. If you have a brokerage, their suite of tools should be available for you simply for having an account. So I'm going to make sure I can see the chat box here. Oh, where's the chat box? Oh, that's right. You guys are on the same browser. There's the chat. Okay. So as long as you can see these guys, look for a ticker symbol, and I'll show you how. I'm going to compare and contrast a stock that's very liquid and a stock that's not as liquid. So let's take a look. Microsoft, first stock ever bought, very liquid stock. And when you pull up the summary page of Microsoft, how you can tell how liquid it is look for the volume. The volume, and I'm going to make this a little bigger for you guys to see. So the volume is how many shares are bought and sold on a daily basis. The volume today is almost 13 million shares, so it's super liquid. I actually try to look for a stock that is selling at least 1 million or more shares a day. That's pretty liquid. Average volume, again, Microsoft is heavily traded each day. So on average, there's about almost 22 million shares traded. So it's a super liquid stock. It gives me the confidence that the price I'm going to get either as a buyer or a seller is going to be a pretty fair price. And how can I tell that? Generally, you want to be able to see a very small difference between the bid and the ask price. So the bid is the price that people are willing to pay for Microsoft stock today, and the ask price is what people are willing to sell Microsoft stock today. So it's less than $1. It's pretty narrow. As a matter of fact, when you're looking for the bid or the ask, that's called the spread. In other words, you want to see that difference in pennies. You want to see that pretty narrow. Let me see if I could find a narrower example. Let's look at Pepsi. Pepsi is a relatively safer stock to invest in, I guess. Let's see. Oh, actually, their bid and ask is actually it's actually wider. Didn't quite expect that. Let me see.
So what would be like
Look at Apple.
like your threshold as to what's narrow, what's
Well, generally, yeah, I like to see the difference in pennies.
pennies?
Yeah, less than $1.
Less than $1.
Yeah, and the reason why you don't want that big of a gap between what the buyers and sellers are willing to pay, because it's going to be hard to get as fair a price as possible. It's going to hit too far of an extreme either way. You want that gap to be pretty narrow. Like Apple, for example, there's a very small bid and ask. So we're talking about 36 and about 45 cents difference between bidders and asking price. So their price is pretty fair between the market buyers and sellers right now. And I'm actually kind of glad because I sold Apple when it was up today. So that was a good thing. So liquidity is very important. Let me show you an example of a not liquid stock. So let's take a look at Berkshire Hathaway, Warren Buffett's company. There's a huge difference between let's look at the volume. This one only has 1,489 shares today, way under 1 million. When you see volume that low, let me make sure I don't have any questions. When you see volume that low, it's very illiquid. It's not liquid. So there's going to be a huge difference between what buyers and sellers are bidding on the stock. So here's the buyers, 744,763. The sellers at 745,476. So almost $1,000 difference. So it's going to be really hard to get a great price a fair price between the buyers and sellers because they're going to try to swing you into either extreme. So another one that a lot of stocks that are not as liquid, penny stocks. So you always have to beware because a lot of those are thinly traded, and not only is it hard to get a fair price, if the stock doesn't do well, which a lot of penny stocks don't do well, unfortunately, sometimes it's hard to sell them all at once because there's not going to be as many buyers willing to take those losing shares off your hands. So you always have to be careful with those. So again, liquidity is the number one rule. Hey, come on in. Glad you made it. We just started. We're talking about one of the suggested topics. What are some things to look for when shopping around for a stock?
Okay.
So liquidity is one of them. You want shares that are at least a million shares traded a day. So because that way it helps ensure that you're going to get a fair price for the stock.
From my inaccuracy, how do you see how many shares?
Well, I'm going to show you right now. So for example, like Apple, look at the volume. Volume is the number of shares that's traded every single day. Right now, there have been 25 million shares traded so far today. So I usually look for at least a million shares. So Apple is certainly very, very liquid. So it definitely meets that criteria. And you want to see a very narrow difference between the bidding and the ask price. So what people are willing to buy the stock and what people are willing to sell the stock. Usually you want it less than $1, to get a fair price. So that's my top thing that I look for. So let me go back to the meeting box. Everybody's good there. So the second thing that you want to maybe shop for an underlying stock is market capitalization. And there's different rules of thought, but if you're investing in stocks for the very first time, then look for companies that are worth $1 billion or more. You're looking for large cap because you know that they probably sell products and services that people are going to buy regardless of what the economy is doing. If they've reached $1 billion in value for a good reason, it's because they're probably not going to go out of business anytime soon. They sell products and services that people buy. So how do we find out how big a company is? How do we find out what their market capitalization is? Well, Apple happens to be one of the most valuable companies, if not the most valuable company in the world. And you can look at their market cap right here on the summary page where it says market cap. And it's right here, it says 3.74 T, and that's T meaning $1 trillion. So Apple is the most valuable company in the world, at least as of today. It's worth almost just under $4 trillion. So it's I hope it keeps on going on. Let's take a look at maybe another common company like McDonald's. How big is McDonald's? Is it possibly worth investing in if it meets the market cap criteria? Yeah. They're worth $222 billion. So again, it meets that $1 billion criteria. So $1 billion for me is like mid-sized companies, so anything between $2 and $10 billion is a large-sized company. So at least $1 billion gives me at least a comfortable level. So they may not be the biggest company, but they're at least $1 billion company. So I'm looking at that, which is mid-sized to large-sized companies. And of course, you think $1 billion, $1 billion sounds huge, but when you're talking about corporations, that doesn't necessarily mean like the big boys. So between $1 to $2 billion is like on the high end of a middle-sized company. As odd as that sounds, that's just a middle size. But $2 billion and more, those are like the large-sized companies, and those are the ones you've probably heard of. At least these are names you all should be familiar with. Like, let's take Coca-Cola, one we've probably heard of. I don't think they're going out of business anytime soon. How big are they? Well, they're $306 billion, so they're a large-sized company. Or two companies that just are just going to be releasing their quarterly earnings this week: Target and Home Depot. Home Depot, they've been around for a while. Oh wow, their stock's up big. They're a $396 billion company. So look for those. If you're looking for starter companies to invest in, take a look at the big boys. All right. So another criteria, I say price per share should not matter if you're buying quality. So I'd rather own one share of, say, Amazon, for example, than 1,000 shares of some penny stock because it passes the Swan test. Anybody ever heard of the Swan test? No? So the Swan test is a funny acronym. I call it the sleep well at night test. So as long as I could sleep well, wake up the next day knowing that the stock didn't tank overnight or is suddenly worthless, like sometimes a lot of penny stocks are because of their low volume and volatility, then I know I did all right. I have confidence that I'm not going to lose my money anytime soon. I can buy pieces of those shares every time. The nice part about modern technology, by the way, and let me pull up Amazon, actually, now that we're talking about it. A lot of these company shares are not cheap. So you take a look at Amazon, $208 a share. That's pretty expensive for most households to afford. Let me show you another one that I just started adding to this month. I mean, I've had shares, but I started re-adding to this month, and that's Netflix. $970 just for one share. Very expensive, but because of modern technology, a lot of the apps like Robinhood, for example, which I enjoy using, you don't have to buy a whole share. If you want to buy a quality company that makes a product that people are going to buy, like Netflix, for example, you can just buy pieces of it. So like when I get my first paycheck on the first week of the month, I will go ahead and just put $100 into one stock, $100 in another one, and I'll buy pieces of them. So yeah.
Like a quarter of a share?
Sure. Yeah. Well, as a matter of fact, when Netflix was over 1,000 share, earlier this month, I put $100 in. I just bought a tenth of a piece of Netflix.
I have to check out Robinhood because I might think about.
Yeah. I like the fact that Robinhood has zero commissions, and they're one of the few that let you do fractional shares.
Right.
A lot of brokerage firms require you to buy shares as whole shares, which can be prohibited. Yeah. You just put your money in.
Okay.
As a matter of fact, they were the first online brokerage to charge zero commissions. They basically broke the industry because what they had prior to Robinhood is they had discount brokers. And they said, oh yeah, every trade only costs you $4 a trade or $3 a trade. 30 years ago, it cost you like $15 or $20 just to trade one stock for one transaction. And so Robin said, oh no, we're going to change the game. We're going to charge zero commissions. So, which means 100% of your money is going to be working for you instead of part of the commission going into the brokerage's pocket. So once all the biggest players for trading stocks, when your Fidelity, your JP Morgan, your Ameritrade, Scottrade back then, once they realized that everybody's going to go to Robinhood because we're charging commissions and they're not, all of them had to cut to zero commissions. So that's actually an industry standard now. So like Casey Trade, Webull, Robinhood, Schwab, they don't charge commissions for trades in. So, but if it wasn't for Robinhood being the first, then they wouldn't have had to drop those commissions and fees for trading. But what I like about Robinhood versus, and I have a lot of different brokerages that I use, I like the fact that I can do fractional trades in Robinhood. So again, just first, let's see. There are others. There was one that I used for quite a while, but they charged like 99 cents to do a fractional trade, which I was okay with because it was cheap. But now all the fractional trades I do is through Robinhood. Now, for reinvestments, I think my Schwab account will do fractional share reinvestments. But for now, for my fractionals, if I don't want to buy whole shares, I just do my Robinhood just because it's probably a little more user friendly in terms of it's a less complicated app to use. So you could buy fractional shares when you're shopping around for a stock. So again, buy quality. Never let the price of a stock deter you from buying into a quality company, because you could buy $5 worth, you could buy $10 worth. But the nice part about it is you can use a concept called dollar cost averaging. So what that means is as long as you are disciplined to put the same dollar amount around the same time every week or every month or every biweekly paycheck, then you take luck and you take timing out of the equation. So you don't have to worry about when's the right time to buy. Well, just buy it at the same time each month. Put the same dollar amount each month. That's what I'm doing. $100 a month into each of 2 different stocks. Like for the last couple of years, I was doing $100 into Alphabet and $100 in Amazon. This month, I decided to switch it because the momentum seems to be in Netflix and Meta. So I'm putting $100 into Meta and $100 into Netflix. I'm keeping the other shares that I bought, but over time, as long as I've been buying them the same time, same dollar amount each month. Whenever the stock is up, I get to buy less shares when they're more expensive. So this disciplines yourself from trying to buy at too high of a price. But when shares are down like they are today, that's actually good because I get to buy more shares when they're cheap. So over time, as stocks generally rise, the average price that I've paid for my shares will be lower than what the actual market price is. So that's what the concept of dollar cost averaging is. You just have to be disciplined to make sure to do it at the same time each month at the same dollar amount each month. So for me, it's like $100 at the beginning of the month. So stick to simplicity. Vanguard, which is Vanguard's Jack Bogle. Vanguard's the biggest mutual fund company around. So Jack Bogle was one of the founders of the index funds and a very well-respected investor. And so he was always an advocate of simplicity in investing. So sensible allocation to average high-quality stocks, which helps you balance risk and return and your costs. So again, you don't have to look for what the sexiest stock is or the ones that are getting a lot of meme hype or meme stock hype. Just buy stocks of companies that, or start out with stocks of companies that are just going to be selling products and services that people want to buy regardless. So like when COVID was out, I mean, you could just simply just invest in companies that made toilet paper. I mean, what are some other things that people always want to use? Toothpaste, deodorant. If people are cooking in more, spices. I mean, I even though it's not good for me, I still like eating junk food from time to time. So probably one of the biggest junk food companies in the world, PepsiCo, because they make Frito-Lays, they make all the sodas, they make the drinks, they make Starbucks iced coffee, they have Quaker Oats, they have Gatorade, they have Eagle Snacks, they have a lot of different foods and drinks under their umbrella. Coke makes just drinks, but I always preferred Pepsi because they have a more diverse product line in food and beverages. So it's a lot of different things that you've probably heard of. Does the company have increasing revenues or increasing profits? Take a look at their cash flow. So again, you shouldn't have to pay for this information. You can look at it because these are all publicly traded companies. They have to submit their quarterly reports to the SEC. And so, for example, in Yahoo Finance, an easy way to look for it is just click on financials. So we'll look at Netflix. And you can actually see their 3 main financial statements. So there's the income statement, the balance sheet, and the cash flow. So what about income? Is their income increasing? Well, you can just look at the bottom of their income statement, and you can look at their, let's see, their earnings. Okay, earnings per share. So looks like it's very attractive for Netflix. So we had in 2022 earnings per share of $10.10 a share. Then in 2023 it was $12.25. 2024 huge jump, $20.28. So their earnings are going up very nicely. It's a good, nice positive trend. What about the revenue? It's hard to fake revenue. It's hard to fake cash even more, but you want to see a positive trend. And looks like Netflix has a positive trend. $31 billion, $33 billion, $39 billion last year. So that looks pretty good. What about their cash flow? Cash is king when it comes to finance. So you want to see them generating cash flow. Now, even if they have negative cash flow, they might have a good reason why. They could be investing in capital, or machinery, to make their business grow. Amazon uses a lot of their cash to invest in their distribution center, so it doesn't necessarily mean that's a bad thing. But let's take a look at their ending cash. Cash flow actually looks positive. So they had, at the end of the year in 2022, they had $5 billion in cash. In 2023, $7 billion in cash. And the end of 2024, $7.8 billion in cash. So cash flow looks good too. So I could see why Netflix stock has been doing so well over the past year. So that's a good thing. Does the company pay a dividend? Now, not all companies pay a dividend, but let me step back and explain what a dividend is, first of all. So all a dividend is just a piece of the profits that a company pays to their stockholders, whether it's every quarter or every month or every 6 months. So I like, and I have been buying more shares of companies that pay me cash. Basically, I get cash every week for sitting on my butt playing my Xbox or sleeping. And it is my favorite way of making money, by owning shares of stock that will pay me a dividend. So does the company pay a dividend? Not all of them do. A lot of tech companies don't, but you buy tech companies for the stock price growth. So if I go back to the summary here, where do I find the dividend information? On the summary page. You would find it here under forward dividend and yield. Netflix doesn't have it. So they take all their cash and they reinvest it back in the business. That's not necessarily a bad idea. Even though they don't pay a share to the shareholders, they're reinvesting in trying to grow the business. And when they grow the business, that means the stock price generally can go up if their investments are.
Why some companies would decide not to pay dividends?
Yes, they want to grow the company. Amazon doesn't pay one. Google just started paying their first dividend last year after decades of not paying a dividend. A lot more mature companies that have been around a while pay a dividend. For example, Apple, even though they are a slower growth company, but still a growth company, they pay a dividend. So they pay $1 a share. That's $1 a share of free money. The yield is pretty low, but that's just because the share price has been going up. So let's take a look at one of my all-time favorites, Microsoft. So there we go. Microsoft pays a dividend of $3.32 a share. So that's almost 1% yield. This yield here in the parentheses, that just is the equivalent of like the rate that you would get in the savings account. We'll look at what is your account yielding. But it's a function of the cash that they pay out and the stock price. As the stock price goes up, the yield's going to go down. So just because the yield is low doesn't mean that it's a bad investment. It's because with Microsoft, which is the reason why I'm not selling their shares anytime soon, is I expect to get the benefit of both the share price going up over time and getting cash paid to me along the way while I wait. So I have income and also have capital gains as well. Some companies do pay a lot more than others, especially a lot more mature companies like, let's say, PepsiCo. They've been around for a long time. They're not a sexy tech company, but people like the dividend. Look at this, $5.42 a share for Pepsi. For every share of Pepsi. So if you got 10 shares of Pepsi, that's almost $60 of free money, which is great. And that yield is 3.52%. That yield is probably paying you a higher rate of return than the interest that you're getting in the savings account. So which is pretty nice. And you get the benefits of the stock price possibly going up too. Like it's happened to be up today. That's a nice surprise, actually. So don't always shop for yield, because sometimes the yield can be artificially high because the stock price keeps going down. So you don't want to buy a stock with a high yield and then have the stock price keep on going down. So one thing that you can Google for good suggestions for stocks that pay a dividend is you can Google the terms dividend kings, and you can Google the term dividend aristocrats. So dividend kings, dividend aristocrats. Dividend kings are companies that have paid and actually increased their dividend every single year for at least 50 years straight. So it's like them giving you a raise. And then the dividend aristocrats are similar. So it's a slightly larger list of stocks that have increased their dividends that they pay you every year for at least 25 years straight. So those are two good lists to give you ideas of companies to invest in for the first time that pay a dividend. But is the yield sustainable? You want to investigate to make sure that can the company continue to afford paying you that cash? The last thing you want is for them to cut it off. What is its payout ratio? How do we compute that? Basically, the payout ratio is the cash divided by its income that they pay out. So going back to the financials, let me use PepsiCo as an example. It's I like to use Pepsi in my class. So we have, I'm going to pull up the cash flow information here. So dividends is a financing cash flow. So they paid out $7.2 billion in dividends. I'm going to pull up the calculator here. So let's go 7.2 in dividends, and basically if you divide that by their net income, of 9.5. Wow, they don't have it. $9.5 billion. Wow, they paid 75% of their income as a dividend. That's actually pretty high. So if they can sustain it, good for them. Generally, I like to see maybe around 50% or less of their income paid out to the shareholders. Apparently, Pepsi likes to really reward their shareholders. Like they're paying most of their income back to the shareholders. So the reason why I like it about 50% is because it gives them room to give you a raise in the future, and it also gives them some room to have cash in case they need the cash as well. So have they increased the dividend? Is it stagnant or falling? So take a look at that. Another thing you want to shop around for when you're shopping around for stock is, and this is all part of fundamental investing. Basically, you care about what the company does. What do? Do they make products and services that people are going to buy regardless of what the economy is doing? So that's something definitely to take a look at. You want to be market aware about things that go on around. I look at the news differently. I could ignore a lot of fluff of politics, so it doesn't really interest me unless it gives me an idea to make money. So if you hear something on the news that'll affect your investments or how you invest, then I'll pay attention to it. And that's why I call it market awareness. Macroeconomics, what's the economy doing? Like they came out with consumer sentiment surveys this past week or an update today. And people seem to have a sentiment that the economy's not doing as well. So it's likely they're probably going to be spending less money. And what's that doing to the stock market today? It's causing stocks to go down. And so that can affect investment. So macroeconomically, are we in a recession? Is there high inflation? How can that affect investments? What are interest rates doing? Interest rates have been high for the last couple of years until they started bringing it down last fall because inflation was going down. But right now, interest rates are going to still stay high because inflation isn't falling fast enough. That can affect investing. So that's something you want to be aware of. World events can affect it. Is there a tsunami? Is there big fires that could wipe out businesses that you've invested in, or a war? Is there competition? There was big news a couple weeks ago with China developing a much less expensive AI called DeepSeek, and that affected the stock prices of most of the AI companies out there who were wondering, well, can the Chinese one be a lot cheaper to develop? And that remains to be seen. Is there new changes in management? Is a company getting sued? So that can affect the stock price too. So you could take a look at that. Probably one of the most common catalysts you can look at is quarterly earnings. Every quarter, whenever they announce earnings, you can count that the stock's going to move significantly up or down on any given day. Like I showed you Home Depot a little earlier. Home Depot's stock was up 16 bucks a share today. So, and that was because they just announced quarterly earnings this morning that seemed relatively positive. So that can move the stock. So again, all part of being market aware. Look at charts. This is more from a technical trader's standpoint. You could take a look at a chart of how the stock price is moving. So you could take a look today. You could take a look, say, year to date. Are there any trends in the stock price going up and down? When I'm making a trend, usually a bullish trend, usually I like to see the stock price has been going up for the past 2 months. So here's 1 month. What's Pepsi doing? Well, it's been kind of heading back in a positive direction. 52-week chart. So we could do 1 year. Pepsi hasn't done great over the last 52 weeks. It was peaking at 182. Now it's at 156. Doesn't mean it's a bad investment. Maybe not a great one, but maybe it could be in a bargain right now. Maybe it'd be a good time to pick some up before it heads back up. I don't know. Yeah.
How they're doing it.
The effect of the dividend usually doesn't affect stock price that much. In reality, when they declare the dividend that week, it will. So on the date that they call it the ex-dividend date, when the dividend is set to be paid out, usually a few days before, usually the stock will drop on that ex-dividend date, because the people that are listed as the owners will get locked in to be paid to receive that dividend date. So if you want to buy a stock cheaper, it's a pretty well-known strategy to buy it on that ex-dividend date when they announce the dividend and record the owners. That way you can buy the shares when they're down that day. That is like a pretty common strategy. And it's a way to know, at least know that at least on that date the stock's going to be down on the dividend date. Beta. There's another way to gauge how risky a stock is. So this is more from a technical standpoint. Every stock that you're probably shopping around for, or even ETFs or funds, have this measurement, and it's called beta. And let me explain what beta means. Beta just tells you how volatile or risky the stock is relative to the whole stock market. So the whole stock market has a beta of exactly 1. So if you have a stock that you've owned that has a beta of 1, then when the stock market goes up, your stock's going to go up in the same direction. If the stock market goes down, your stock goes in the same direction, and the same magnitude as well. Now, most stocks have a beta of less than or greater than 1. Pepsi, like I said, is a much safer stock, a little less risky. So its beta is relatively low at 0.55. So what that means is that if the stock market goes up, then your stock will go up too, but probably not as much. If the stock market goes down, then your stock may go down too, but probably not as much. So Pepsi's not going to be as volatile as, say, let me put up a really volatile stock, pull up Tesla. Tesla has not been doing great this past. Oh, ouch! Hate to see that. I have shares in Tesla. Its beta is 2.34. Very, very volatile. High risk, high reward. So if the market, since the market has a beta of 1, if the market goes up, then Tesla stock's probably going to go up twice as much or more. If the market goes down like it has been, then Tesla stock's going to tank much, much more than the market is, and sadly, it's doing that today. So beta is another way to gauge risk. So if you want to have a little less risk in your portfolio, maybe you could pick stocks that have a low beta. But then, you shouldn't expect them to really move up that quick, but they could over time. So beta is another way, easy way to measure. Now, betas can have be negative numbers, and that's okay. That just means they move in the opposite direction. So if the market goes up, then a negative beta stock goes down, or if the market's down, then the negative beta stock goes up. And I've traded in negative beta ETFs before, and it's actually not a bad idea because you can kind of hedge your bets. So if the market goes down, if you have a negative beta investment, then it'll actually increase in value in the opposite direction. I actually have one in my portfolio now. I bought several shares of a stock that moves in the opposite direction when a lot of the tech stocks go down. So if there's a crash on the tech stocks, then all those shares that I bought with a negative beta are going to be really valuable. Hasn't happened yet because the tech market's actually done pretty well the last 3 years. And then we have technicals. You can take a look at moving averages, and on a chart, and I'm going to make this a big chart, you can actually see or set up moving averages. So, for example, you could do a 50 and a 200 moving average. Let me do a 200 moving average. Period 200, and I'm going to make that purple. All right. So the purple is a 200-day moving average, and the red is a 50-day moving average. So on average, this is what the stock's been doing over the last 52 weeks. And so one thing that, or one metric that you can look at if you're starting to look at technical indicators for the first time is you could look to see if the 50-day moving average crosses above or crosses below the 200-day moving average. And what this means in English, if you want to interpret it, is if the 50-day moving average, in this case it's the red line, drops below the 200-day moving average, which in this case is the purple line. Take a look at it right about here. Generally, that's considered a bearish signal, meaning that there's a good possibility that the stock might keep on going down. And well, look at that. The stock did right after it crossed over. Sometimes, if the 50-day moving average, again the red line, crosses above the 200-day moving average, like it did right here, then generally sometimes that's a bullish signal, meaning the stock is possibly going to continue to go up, which is what it did right here. So if you take a look here, it looks like there might be a potential crossing right here. So if this 50-day moving average, and you can always keep an eye on it, crosses the purple line or above the 200-day moving average, it could mean that Pepsi stock might be, or Tesla stock might be heading back up. I hope so, but it's not looking like that might happen anytime soon. So when the 50 crosses the 200, there's a nickname for it. It's called the golden cross. And when the 50 crosses below the 200, that's called a death cross. So the death cross pretty much predicted this drop here. The golden cross kind of predicted this little rise here. So it's kind of interesting, but if there's any technical tool that you could take away, this is probably the easiest one to understand and set up, and you can just keep an eye on it. So if you see it maybe approaching a golden cross right here, maybe it's a good time to buy it before it goes back up. Usually you like to confirm it to see if it stays above the 200-day first, and then maybe you could jump in. Or short a stock or sell a stock before it, or right after it crosses below the 200 before it drops down. You can actually make money when the stock's going down too. So hopefully that gives you a lot of different tools you can use when you're shopping around for a stock you might be interested in. So hopefully it made some sense. Good. The last topic that was suggested for this month, and this won't take too long, but I'll go over the list. One of our attendees asked, well, besides NVIDIA, which is like the darling of artificial intelligence stocks, are there any other ones that you could possibly take advantage of to invest in, since AI is the big new thing right now and probably will be for the next few years? So AI stocks other than NVIDIA. What I did was I basically looked at my watch list. I actually have a folder just for AI stocks, and I didn't put all of them in, but I put some that I was familiar with, just for you to take a look at. Again, none of these are recommendations, but at least they are affiliated or having something to do with AI, whether they supply materials for AI, like Dow Corning, because they provide like the materials for like fiber optics, or SMR. They are an energy company that are contracted with tech companies to buy like nuclear energy to help power AI servers, or Texas Power and Light. Rigetti, that's one of the newer AI companies. A lot of familiar names: Netflix, Meta, Microsoft, Amazon. Arista Networks, so networking company, since AI needs networks. Palo Alto Networks, there's ServiceNow. AMD, they make chips, which is actually a direct competitor to NVIDIA. Tesla, yeah, they are an AI company because they also make robotics as well. So there is a company whose stock symbol is actually AI, C3AI. Palantir, that company's done so well. I bought Palantir shares, I think when they were, and I wish I bought them when my students suggested it, when I was teaching a class a couple of years ago when it was in the teens. And now Palantir is like probably $70 a share. I think it reached over $100 a share last week. So in a very short time. IonQ, there's Apple, ServiceNow, customer relations management software for businesses. They use AI. Amazingly enough, financial companies, Visa, that's V, they use AI. IBM, of course, one of the pioneers in supercomputers. Alphabet, they have two symbols. You can buy Google and Google. I trade in both. ARM Technologies is awesome. ARM Technologies, they make the chips that are in smartphones for about 99% of the world's smartphones. And they went public in 2023. I bought some shares at like 30 something, $35 a share. I think ARM probably reached like $130 a share in a couple of years. So I've been really happy with that investment. There's Fortinet for cybersecurity. Dell Computers, you've probably heard of that. Match.com, the dating site, which also I think it has several dating sites under the Match.com umbrella. They've been using a lot of AI to match people to date. So there's a lot of different ones. Feel free to do your research, take a look at these. SoundHound is one. However, NVIDIA basically dumped all their shares out of SoundHound, so maybe that's one maybe not to get into or short. So again, we got the handouts with this list. It's not all inclusive, but these are all the ones that I've looked at for AI. So hopefully you find them helpful and give you some ideas if you want to diversify in investing in AI. I'd probably start with the big boys though, because they're probably a little less volatile, probably not going to go out of business anytime soon. I think the one that for me is the most attractive, at least right now, is probably Meta. I think Meta has done such a good job with AI. Palantir, possibly, their stock actually is cheaper over the past week because their one of the primary revenue sources is government contracts. So they do a lot of AI and technology for the Department of Defense. So that's where they get their money. So if you get a defense contract, generally that could be pretty lucrative. But other than that, we are on time. I always like to stay on time. If there is any questions or anything you guys want to chat about before we head out? I know you had a lot of stuff you got exposed to today.
We're showing that chart with the purple line, the 200 days.
Yeah, the averages.
Yeah, so is that like, so you said that was like in a 200 day span or like?
Yeah, well, basically, yeah, it's like a rolling 200 days. So every single day they'll take the oldest day off and then add the newest day. So it's like a rolling 200 day, just like the rolling 50 day average.
They calculate like that threshold of whether the stock is bearish or bullish.
Well, sometimes you kind of have to be the judge from your own experience of if you think you see a bullish or a bearish trend. Oh yeah, Tyrone, good question. As long as I have your email address in the email, which I'm assuming you should since you got the link, or if I don't have your email, I'm glad you sent this to me. Yes, I always send out all the handouts in email after the meeting. So yeah, I will definitely send you the handouts. But yeah, the Golden Cross, or Death Cross, that's one way you could look at it. But for me, usually I just kind of eyeball it over the last. I usually like to do a 2-month chart. I like to see what it's been doing. If there's a trend. Sometimes trends probably one of the easiest things you could take a look at. Yeah, good question, Tyrone. Yeah, I am moving overseas. As far as the Moneymakers Club, I just hired or helped hire 2 new finance professors, one of which is going to be hopefully taking over the club, and I hope she does a great job. And I'm going to be sharing all of my stuff with her so she can use it, including the club charter. So she's going to be doing that. I mean, I'll still be here because this will be my last full-time year. I'll be here through May, when the spring semester ends, because May will be the last club meeting. And then we always take the summer off for club meetings, and then it usually starts up in the fall. So she'll be the one to start it up in the fall. And I will be in another country or at that time. But yeah, I'm sure she'll do a great job. She can kind of continue the club. Is there a difference in buying into funds versus ETFs from looking at the information? Yeah. For me, the biggest difference between buying into funds versus ETFs is the ability or the speed in which you can buy and sell your shares. So with mutual funds, you got to do a little more paperwork to put your money in and take your money out. But the advantage of ETFs is that they could trade just like stocks, and you could get in and out of ETFs using any of the brokerage platforms and buy and sell and execute your trades in a matter of seconds, with just like stocks. So most of what I buy every week are actually ETFs, and I'll buy a couple of the stocks each month. But I like ETFs because you can get the same diversity as mutual funds without all the with the speed of buying and selling stocks. So that's why ETFs have become more and more popular these days. So yeah, great question. All right. Any other questions out there? All right. Well, I appreciate everybody, both online and in person, to come, and hopefully have another great turnout tonight. Thanks, everybody, and I will see you all next month. Unless you're in my class, then I'll see you next class. Bye, everybody.